Welcome to our live webinar, Decision 2016, Which Path Will You Elect to Go? A Pension De-Risking Market Update. On behalf of the entire team at Dietrich & Associates and Prudential, thank you for tuning in to our live session. My name is Krista Kotelis, and I'll be the conference moderator this afternoon. If you're having any technical difficulties with your webinar software, please direct those issues to our tech manager today, Lisa Strout, via the chat feature on your control panel. All questions asked during the live session will be answered at the end of today's presentation. They can be sent via the question feature on your webinar control panel. Any questions that we aren't able to get to today will be answered offline. Our panelists for today's session are Alexandra Heighton and Margaret McDonald with Prudential, and Jeff Dietrich of Dietrich & Associates. Alex Heighton is Vice President of Distribution for Prudential's U.S. Pension Risk Transfer business. She is charged with identifying and delivering solutions for defined benefit plan sponsors as they seek to reduce or remove the risk associated with their pension plans. She also delivers valuable consultative guidance to intermediaries, investment consultants, actuaries, and pension committees as they weigh the benefits of group annuities against their short and long-term objectives. Peggy McDonald is Senior Vice President and Actuary for Prudential's Pension and Structured Solutions business, where she focuses on providing innovative strategies for sponsors seeking to mitigate the risk associated with their pension plans. She has over 25 years' experience as a pension actuary. In her role in the pension risk transfer team, Peggy has led a number of large transactions, including the recent agreements with Motorola, Bristol-Myers Squibb, and J.C. Penney to transfer pension liabilities. She led the market-defining pension buyout transaction with Verizon Communications, and she was also a senior member of the team that executed the first U.S.-based pension buy-in transaction. Jeff Dietrich is the Executive Vice President of Dietrich & Associates. Jeff has been helping plan sponsors manage pension obligations for over 15 years. An experienced consultant, underwriter, and transition manager, Jeff has served as a trusted advisor to Fortune 500 companies, municipalities, and the Pension Benefit Guaranty Corporation. Jeff works directly with plan sponsors, actuaries, pension attorneys, and the highest-rated life insurance companies to provide custom de-risking solutions. Now that you've had a chance to get to know our panelists a little more, I'll go ahead and turn the presentation over to Alex.
Thanks, Krista, and thank you for that intro. And thank you for everyone who has logged on today with us. We do only have about 45 minutes and have a lot to cover, so I think we'll just jump right in. Couple of things we want to cover today. Couple of things. First, we're going to talk about what's going on in the pension market and the trends we're really seeing to de-risk. We'll get both Peggy and Jeff's perspectives on that. And then we'll talk about the products and solutions available if you wanted to start heading down the de-risking path of your pension plan. And finally, we'll reserve the last 10 or so minutes for a Q&A. So really over the last couple of years in the United States, there has really been this trend for plan sponsors of defined benefit plans to utilize different de-risking strategies in order to reduce the financial statement exposure of their pension plans. We'll hit on a couple of these strategies later, but they really include plan design changes, asset strategies, or even a complete transfer of risk through either lump sum programs and annuity buyouts with insurance companies. While all of these strategies should be considered and are very useful, really what we're going to focus on for the next couple of minutes is annuity buyouts with insurance companies. There's been a huge increase in activity over the last couple of years, and that's really what's shown in front of you. Just to kind of give you some background on the years prior to 2011, really before 2011, the market has really been about $1 to $2 billion per year. 2012 was kind of a record-setting year with $36 billion in transactions, and that included the GM and Verizon transactions, and that's what's kind of illustrated by the $25.1 billion, that would be GM, and the $8.5 billion, which is Verizon. But kind of putting those aside, in 2012, the total market was about $2.4 billion. 2013, it almost doubled to $4 billion. 2014, over doubled to $8.5 billion, and finally last year, still another significant increase with the market about $14.4 billion. So my first question for Peggy and Jeff, with all of this activity over the last couple of years, where really do you see the market ending up in 2016? Jeff, let's start with you.
I think all predictions. Thanks, Alex. And good afternoon and good morning to the Left Coasters. Thank you for joining today. I think the projections for 2016 were to follow 2015 or increase upon the volume of activity that was coming to the marketplace. I expect it to be that. We did get off to a slow start this year, given some activities in the equity markets and some loss in interest rates. But I expect that regardless, or unless the bottom completely falls out here, that the pent-up demand will eventually come to market by year-end 2016. The demand is still there. The supply on the insurance company side is still there, and basically what that means to anybody looking to affect a risk transfer in 2016 is that now's the time to really begin proactively marketing of your plan and understanding your options and the cost to do so, because human capital from a standpoint of market intermediaries and insurance companies will become more limited as the year goes on.
Peggy, what do you think?
I'd agree with that assessment. I think we'll probably end up where we were last year or a little bit better than where we were last year. I agree with Jeff. It's been a bit of a slow start to the year. And I think there are some headwinds in terms of plan funded status for some plan sponsors that are causing them to delay a little bit. But I think the demand is still good. What we see as activity is still pretty strong and heading toward about the same size market, maybe a little bigger than last year.
And Peggy, can you touch a little on what types of activity you're seeing? Is it really full plan terminations, or is it buyouts like GM and Verizon where it's just the retirees?
Yeah, I think we're seeing really a mix of both. So on the plan termination side, sort of a trend I would say over the last year or so is larger plan terminations. So we used to see a lot of $10, $20 million plan terminations. We're now seeing much larger ones. Some plans that are even, as up to $1 billion are terminating. So that's certainly a trend. We see a good amount of that type of activity, and we still see interest in the retiree buyouts. I would say the one change there is we're seeing particular interest, and I know we're going to talk about specific drivers in a moment, but specific interest in transactions that transfer benefits for people with the smallest, transfer liabilities for people with the smallest benefits. So we're definitely seeing some transactions where a plan sponsor maybe wants to do their whole retiree population, but maybe their funded status has dipped, and so now they're going to concentrate more on the retirees with small benefits to get the life count off the out of the plan as much as possible. So those would be the two trends: bigger plan terminations, continuation of retiree buyout, with some more targeting towards those small benefits.
Great, thanks, Peggy. I know when I often meet with plan sponsors that they are commonly surprised about the amount of activity we're seeing despite the low interest rate environment. I have a list in front of you of some of my thoughts on what's really driving the market. Can each of you kind of pick 2 to 3 reasons why we're seeing so much activity? Let's start with Peggy this time. And Jeff, I'm going to come to you next so you can start preparing your answer.
Mm-hmm. Alex, I'll start off by talking about what I think the immediate drivers are today in the market. I think the biggest one would have to be PBGC premium increases. We've had 3 significant rounds of PBGC premium increases over the last few years. We're now looking at a fixed premium of $80 a person in the near future, variable premium of 4.1% of unfunded liability. Those are very big numbers. And that is a huge driver of some of the activities that we've seen. As I just mentioned, we're seeing some plan sponsors looking to annuitize retirees with small benefits. This is the big driver of that. I can't afford to do the whole thing maybe, but I really want to do something to reduce my PBGC premium. We're also seeing it in the vested term lump sum windows. This is a factor that comes into play because, again, vested terminateds tend to have small benefits. So for a relatively modest payout, it enables a plan sponsor to save a lot in premiums. And I think it drives plan terminations as well. Plan sponsors who may be on the fence when they consider what they're paying in PBGC premiums and what they're going to be paying going forward, saying, I'm going to pull the plug now. So that's the biggest driver in my mind. I'd say the second biggest one would be the substantial increase in liability that we saw with new mortality tables that came in well over a year ago now. Those tables in general increase liability for a plan sponsor somewhere between 5%, 6%, kind of pick your number there. But in any event, by a substantial amount, it kind of wakes up plan sponsors to say, wait a minute, I'm really taking some risk here. This is not a risk I understand. This liability risk, I got to mark up my liabilities approximately every 10 years in the U.S. for this. So it's a reminder that asset risk is not the only risk involved in managing a pension plan. And we haven't reached the full impact of those tables, so they have been phased in for plan sponsors for accounting purposes. Almost everyone uses a new basis, but for funding purposes and for calculations of lump sums, we don't yet know what basis the IRS will adopt. We expect that we'll know that very soon, and that will become effective in 2017 and 2018. So the immediate impact of new mortality tables on the horizon is plan sponsors wanting to pay lump sums now to the extent possible before the table changes. So that's driving some of the plan termination activity, and it's also driving the vested term lump sum windows. So I'm picking that for my number 2. My number 3 I won't say as much about, but I would say it's competitors doing PRT. We always notice that when a plan sponsor does a transaction in a particular industry, the industry is calling us to find out more about it, wanting to talk more about it and understand it more. So I think it's like many other things in business. Once you see your competitors doing something, you start considering it as well. So I'll leave Jeff. Jeff, I think I took the 3 winners here, but maybe you can pick 3 that are, more the longer term drivers of the market.
Yeah, and this is where you're going to show the differentiation of roles here. Peggy and Alex are actuaries. They're the numbers people. I'm an insurance consultant, so I'm going to come from a more qualitative standpoint for the most part, and start with the legacy DB plan. It's an old employee benefit. In many cases, pension plans are frozen, and they're no longer benefiting current employees, workforce, and executives. And I'll tie into that mergers and acquisitions, which is more of a needs-based reason for pension risk transfer. But what it does is it gives those executives more of an objective view of the plan, the benefit of the plan, and then they begin to look at the cost-benefit analysis, shareholder value, et cetera. And even as executives at companies turn over and you're getting new, fresh outlooks on these legacy benefit plans, they see that it's something that is a thing of the past, and we have to figure out how to creatively reduce, remove that risk, especially for frozen plans. The second and third, I guess, is the education. I think that Dietrich and Associates has been in this business for 35 years. There has been a lot of changes throughout that time, more so, I would say, in the last 15 years. And the press, the education out there, whether it's through insurance companies or media or your consultants, it is really increasing awareness of the embedded risk in pension plans. And as that awareness increases, the appetite for that risk is decreasing. And executives are seeking options to alleviate this risk and the feasibility of doing so, and then how to actually do it. You want to go back a slide there, Alex? We can transition into, so from an education standpoint, really the basic, outside of understanding the objectives of a plan and a frozen plan, it's pretty straightforward that the next step is plan termination. But how do we get from here to there? When Dietrich and Associates is engaged, we usually start with simply understanding the numbers. And this is something that, as you'll see on the next slide, that has really changed as a result of regulations, and regulatory risk is very real for plan sponsors, as Peggy mentioned, with changing mortality and PBGC costs. If you look at the top of this funded status roller coaster slide here, those things across the top below the economic changes are all regulatory changes over the last 15 years that have affected plans. So when we're going back to understanding the numbers. Where we start is explaining to a plan sponsor that there is a difference between where you have been funding the plan or where you've been required to fund the plan versus what you're accounting for that plan on your balance sheet versus what it's going to cost to actually settle that liability. I think historically, plan sponsors have looked at risk transfer as an expensive option, but due to regulation and increased awareness, plan sponsors are starting to understand that the difference is really the economics of running a plan, and that's essentially what you're doing with a risk transfer is you're turning that over, that unknown and that cost of ongoing administration to an insurance company, or in the case of lump sums, to the participants. And more importantly, with the PBGC, or I should say more visibly now with the PBGC, the changes in the premiums, the changes in the measuring rate of those premiums, it's just becoming, the cost, the risk is becoming more and more apparent. So that's where we start, and understanding how are you looking at your liability when you say you're funded, whether you're 80% funded or 120% funded, what does that mean? What basis is that, and what is driving that basis? I'll leave the concept with at this, that liabilities are valued based on two assumptions: an interest or discount rate assumption. So basically, what am I going to earn on my money and discount those future cash flows that I owe to my participants based on that rate, and how long are those participants going to live? In other words, how long am I going to be paying those benefits? And when you look at the different liability measures, they're all based on different assumptions of interest rates and mortality figures. As you move your way down this chart, you're getting closer to reality as opposed to assumed rates published by regulatory bodies.
Thanks, Jeff. Peggy, I'm going to go back to the funded status roller coaster for a second. It looks like there was clearly a large drop in funded status in the early 2000s, but then plans kind of turned it around and reached full funding by 2007. Why didn't we see a lot more of activity then?
I think there are a couple of different reasons, Alex. I think one reason is that most plan sponsors still had active, ongoing defined benefit plans that were significant, were really the central feature, or perhaps right alongside the 401k in their retirement offering to their participants. So it would have not have been the first thing that would have been on their minds. I think also that some plan sponsors were not prepared, and I know that I have been a consulting actuary for years, would talk to plan sponsors about wanting to terminate, wanting to do something, and they simply weren't ready to take advantage of that relatively short period of time that plans were more than 100% funded. And then once we had the recession and funded status decreased so much, nobody could really afford to do anymore, nor was it the first thing on anybody's mind, right? You're trying to save your business. You're not trying to save your pension plan. A lot of people wish they had done something sooner, but they hadn't. And that was really the advent of the serious de-risking, the serious LDI conversations, the large retiree buyouts, the increase in plan terminations, and the freezes and closings of pension plans. And now somewhere around 70% of all defined benefit plans are either closed or frozen. So all those things that are contributing to activity today.
Thanks, Peggy. I think we're going to switch gears a little bit now and talk more about the different strategies available if plan sponsors wanted to de-risk their plan. So what we have in front of you is a spectrum of pretty much going from risk retention versus a full risk transfer. So starting all the way over at the left, this would be retaining risk. So you might have something like a 60-40 equity fixed income allocation. You could be taking advantage of MAP 21 and the funding relief and only making minimum contributions to your plan. So that would be kind of what we would consider status quo. If you take one step towards managing the risk, I would say it would be most likely through plan design. Peggy just touched on this, said something like 70% of plans have either closed or frozen. So closing plans obviously would eliminate the risk that any new participants would enter your plan, and freezing benefits would just not allow the benefits that are in your plan to grow any further. The other option we have listed there is switching to a cash balance plan from more of a traditional setup of a DB plan. This isn't as popular anymore. I think most plan sponsors have switched fully to the DC plans, but cash balance plans were more popular in the 90s. Some plan sponsors choose to take a more asset approach, so they can choose to opt for a glide path. A glide path essentially means that as plans become better and better funded, that the allocation would switch out of equities and into fixed income. And then there's liability-driven investing, which is essentially just matching your assets and liabilities. And then if you wanted to fully transfer the risk, there are really three options available to you. One would be lump sums. Lump sum programs, as Peggy and Jeff both commented on, have been very popular over the last couple of years. And really what happens in these programs is plan sponsors offer their former participants a one-time lump sum payment in lieu of their future benefit payments. And plan sponsors we've seen typically have been able to successfully reduce their term vested population by about 50 to 60% through these programs. And then there's the two insurance options of buy-ins and buyouts. Buy-ins have not been as popular in the United States. They're much more popular in the UK. But with a buy-in, both the assets and the liabilities would remain on your balance sheet. And essentially what you would have is an asset that perfectly matches the liability. I kind of think of this as a perfect LDI strategy. And I would just make a small comment that the reason why this hasn't been as popular in the US, I believe, is primarily due to the fact that with a buy-in, you would still retain the PBGC premiums. You'd still be forced to pay them. And then there's a buyout. So with a buyout, is a complete settlement of the plan liability, where the assets and the liabilities would be transferred to an insurance company. So the plan sponsor would essentially be wiping their hands clean of this risk. So with that, Jeff, can you comment a little bit on how Dietrich plays a role in the process of choosing what path is best for them?
Absolutely, Alex. As I mentioned earlier, Dietrich & Associates has a 35-year history of being a nationally recognized independent expert in transferring pension risk. We're not asset managers. We're not plan administrators. We are risk transfer specialists. And what that means is we start with helping plan sponsors and their intermediaries understand the risks that are out there, understand the differences between the numbers, as I said earlier, where plans are being funded versus what it will cost to actually transfer that liability. And then we have a turnkey process in carrying out that transfer, which is from day one to the last participant's benefit is paid out, an objective process that basically brings the plan sponsor to the market of insurance companies that offer these products and solutions in a compliant manner that, as regulated under ERISA, the DOL, you name it, IRS, PBGC, which is more important now than ever with the activity in this market, as we have seen. Engaging a specialist to take you to the marketplace and help you understand your options is necessary just to actually gain access to the market, because there is a lot of demand out there.
So Peggy, if I was a plan sponsor and I was looking to reduce some exposure on my balance sheet to my pension plan, do I have to choose just one of those options that we just kind of talked about, or is there a different strategy?
Well, I think, Alex, the slide that you just put up here is a good illustration of the way that plan sponsors think about their pension plan as they're evaluating risk transfer options. So the pie chart in the middle of the page shows the breakdown in a typical plan's liability between the retired population and the active invested terminated population. So that's really where the liability sits in a typical plan. And if we just focus on the pie chart, we'll get to the gray boxes and the barrel on the bottom in a moment. The risk transfer strategy of choice for retirees is almost always a buyout. And that's true whether it's a retiree-only transaction or whether it is a full plan termination. And the reason why it's a buyout is the best solution for the retiree population is, number one, there are regulations now that say you can't offer lump sum windows to retirees. You could still do it on a planned termination basis, but you can't do the ad hoc retiree lump sum windows that we saw a few years ago. These folks are already collecting their benefits, so it's no disruption to them if you just go through with the buyout. They would literally know nothing ever happened except the money is wired from an insurer instead of from the plan going forward. And finally, price. And we've seen market evidence of this, that the cost to transact a retiree obligation is generally slightly over the plan sponsor's gap liability. We have some more detail on that we'll share in a moment. But it's seen as very cost effective. It's not disruptive to retirees. It's a relatively easy transaction. And so that is why we see annuities being the choice for the retired population. It's a different story when you look at the non-retired population, so both of the green shaded areas. And here we see liabilities are most typically settled by lump sum. And we've seen lump sum windows in particular the last few years for vested terminated populations, an effort to get, as I said earlier, to reduce PBGC and administrative costs. That's one example. And in a planned termination, let's see, in 25 plus years, I've never seen a planned termination where the groups here in green were not offered a lump sum. So the common practice is to offer a lump sum to this group at planned termination, and you'll get an election rate, and then just annuitize the ones that didn't take the lump sum when you finally go ahead and pull the plug. Why aren't annuities the choice, the number one preferred choice for this group? It's going to have to do with the cost. Annuities for deferred populations are a bigger percentage of gap than they are for retired populations. There's additional risk involved in assuming those obligations for the insurer. And I'd be happy to take questions if anybody wants me to go further on that. But I think that sort of sums up how plan sponsors look at their plans and think about what the options are for the different segments of their population. And Jeff, I'm assuming that you see plan sponsors who think about their plan in a similar way. Is that the case?
Yes, it is, Peggy. And the reason Peggy's asking me that question is because while Prudential has a lot of the well-known name clients, Dietrich and Associates is more of a mid to smaller market risk transfer specialist. And I would say that the trends are very similar down there. It's not a one-size-fits-all approach, so you have to look at each plan, the makeup of the liability, the exposure based on that, and really the objective of the plan sponsor. Paternalistic approach is, we see that a lot where it's a concern when implementing this, even for plan terminations where a plan sponsor has to do this. That is something that is on the top of their mind. But from a standpoint of offering lump sums to deferred participants, annuitizing retirees, segmenting, yes, it's something that we see in our market too. And it really, the discussion comes down to the economics of maintaining the plan or transferring all or portions of the liability. So we're having the same discussions.
Yeah, that's interesting. I'm going to now direct you to the gray bars on the page. And we are frequently asked the question, I'm sure Jeff gets this question too, what does it cost to terminate my pension plan? And these additional notes on the page are designed to help you understand how you can think about that cost. So we look at the retiree side of the equation. We've said at a planned termination, you'd probably annuitize the retirees. It would be reasonable to assume, and we'll talk about that more on the next page, that you could annuitize them for about 104% of the gap liability that you're carrying on your balance sheet. And then when you go to the non-retirees, that you will first offer lump sums to all of these participants. We see lump sum election rates of 75 or 80% when that happens. Now, you may see less than that if you've offered a vested term lump sum window recently, or if you have a permanent lump sum feature in your plan. But that's an estimate that we're using here. You get an 80% lump sum election rate. You buy annuities for the remaining participants, the remaining 20% of participants, which will probably be in excess of 120% of GAAP. Remember, I said annuities for the deferred population are not as cost efficient, and you come up that you would need about 105% of non-retired liability at plan termination. So voila, you put the two together, you see the little circle in the middle. In this example, 104.5% would be the estimated cost of GAAP liability to fully exit the plan. And this is an important point to bring up because in the, I was going to say the olden days, but I'm not old. Earlier in my career, it was typical for plan sponsors to think of the cost to exit their plan as something more along the lines of 100 or 125% of their GAAP liability. I think a couple of things have happened since then. Most notably, the lump sum, the interest rates used to calculate lump sums are now on a corporate bond basis as opposed to a 30-year treasury basis. So the rates are higher, so the lump sums are much more economically efficient. That's the biggest thing that's happened here. I would also say accounting liability is closer to reality than it used to be in terms of recognizing more recent improvements in longevity.
Peggy, can you elaborate a little bit more on how much a retiree buyout would cost and how plan sponsors should evaluate this cost?
Sure. So the next page, as I was saying on the prior page, for a retiree group of participants, the cost to transfer liability is relatively modest compared to the GAAP liability. And what this page does is it illustrates the GAAP liability all the way to the left of the page. It makes the point that the economic liability is really higher than the GAAP liability. So the economic liability in this case is 106% of GAAP liability. The difference between GAAP and the economic value being things like present value of investment expenses, PBGC premiums, administrative costs, all the kinds of things that plan sponsors really incur. So it's really a liability to the plan sponsor, but it's not included in the GAAP liability. And then it also highlights the second point on this page would be that the insurer is a more efficient holder of this type of risk than the plan sponsor. So you see the cost to buy out this participant group is about 2% lower than the economic liability. It's about 104% instead of 106%. A lot of that is due to efficiencies of scale that an insurer has, and it's also due to the fact that we're looking at GAAP liability, which is largely a AA credit quality measure, and insurers in assets are probably invested at something closer to an A quality, not quite the AA standard. So this sort of gives you the rough economics, and I think that you can see why plan sponsors have found value in these these very large retiree lift-outs that you've seen.
So Peggy, you're showing a cost here of 104% for a retiree buyout. Why then have we heard in the market some of these transactions closing at par?
That's a great question, Alex. And this 104% of GAAP liability is based on the assumptions that are shown below in the footnote, sort of a standard mortality table and a standard discount, publicly available discount curve. Many plan sponsors will use a more aggressive discount rate curve, so they may use an above median curve, or they may use some other proprietary model that their consultants use. They may use a different mortality table. They may assume less longevity than this particular table. So I would say that to the extent a plan sponsor uses something more than a Citigroup curve to value their GAAP liability, you would see the premium would be a higher percentage of GAAP because they'd be valuing their GAAP at something lower than what's on this page. And the same is true for mortality. If the plan sponsor is using a mortality that differs from the insurer's view of the mortality, then, and the insurer's view of mortality is that there's less mortality and more longevity, you would see the premium be a little bit higher percentage of GAAP.
Okay, thanks. That makes sense.
Does? Good.
And finally, Jeff, I know we touched on most of this earlier, and we are running a little bit short on time. But is there anything else you would like to add about preparing for risk transfer?
Yeah, I would just say that if you have the slightest inclination of looking at this to look sooner than later, this slide outlines really the steps prior to and after performing a risk transfer. But it does take some time to ramp up and be ready, whether on a just a financial standpoint or a regulatory standpoint. Data is very important in cleansing data, but really it's getting the insurance company marketplace familiar with your liability and the mortality associated with that. Following up Peggy's point in what I said earlier, that every plan is different. You can't just apply the old assumption that I just can't do this anymore. You have to really look at it, figure out what that number means, figure out the process to go through this, and that gives you the flexibility to act when the stars do align or when it makes sense to do it. And as I mentioned earlier, in the market that we're living in now, it's more important than ever to at least get your plan out to market, understand what your options are, and what the process is. And I could talk forever on that. I don't want to take too much time. I'd rather open it up for questions as we have 10 minutes left here.
Great. All right, well, that will conclude the presentation portion of today's live session. And now we'll go ahead and open the floor up for questions. Just a reminder, you can send your questions via the questions area on your webinar control panel. So I'll go ahead and relay any questions the audience has to Alex, who can field the questions over to our panel. So we've got a question here, Alex. It says, what is the appetite and capacity of insurers given the growing market demand?
Peggy, can you take that one?
Sure, I can. I think there is plenty of appetite among the insurer community. We have seen several new entrants or re-entrants into the group of insurers that bid on these liabilities. Jeff could probably give you the numbers that bidders he gets on specific transactions. And I would say there's plenty of appetite. There's nothing in the foreseeable future that would be an issue from that perspective.
Yeah, I would add there's probably about a dozen insurance companies at any given point in the market. They're more coming than going nowadays because they see the opportunity in the marketplace, which is good for plans. I would say that the appetite really is dictated by the market and the liability that's out there. So it can change quarter to quarter, month to month, even. Like we started this talking about 2016. There was a lot of anticipation in the beginning of 2016 that a lot of liability, that this trend was going to continue, and I think that that's still there, but it hasn't, which really meant for plan sponsors that were acting in those first couple months that it was a favorable market for it. And as the year goes on, as we saw last year, because it was more of a front-loaded year from a risk transfer standpoint, the market tightens up a little bit towards the end of the year. And it's not necessarily capacity issues. You look at the size and general and separate accounts of a company like Prudential. It's not that they don't have capacity for it. It becomes a human capital issue, and transferring this liability, especially retirees, and making that transition seamless to them is important. It's the most important part of this, really, at the end of the day, is because that's what, under ERISA, excuse me, you act in the best interest of your participants, and you want to make sure that they're not affected by this. So the human capital, the requirements of the insurance companies to make sure that they are getting the participants set up and the right benefit amount out and in the right manner is important. So that's really where the restrictions come in.
Yep, I agree with you, Jeff. It's less of an insurer capital appetite as it is a manpower appetite. And I know towards the end of last year, there was a flood of transactions coming in at one point in time, and I know some insurers did not have the ability, some of the newer insurers in the market didn't have the ability to price on them, and some of them ended up moving to this year. So that is another reason to get started sooner rather than later. If it's something that you want to do this year, you should get it started and not wait, because there's always a rush toward the end of the year.
Absolutely. That's historically been the market. Last year was an anomaly, and it was interesting. But I think it's going to be back to normal this year.
Hey, I've got another question coming in, kind of in relation to that, actually. The question is, should a plan sponsor wait until interest rates rise to do a pension risk transfer?
I'll take that one if I'm allowed to. That's actually something that I hear quite often, and I guess I would argue that maybe interest rates shouldn't be the decision point, and instead it should be more around either the funded status of the plan or the cash contribution that's required. Of course, interest rates do go into that, but the decision shouldn't be necessarily just around interest rates. And I would also say that right now, I guess one of a very popular option has been plan sponsors actually taking advantage of the low interest rate environment. And what they're doing is they're borrowing at these low interest rates and choosing to fund up their plan and potentially transact on a portion of their plan and reducing that risk. Especially knowing that the PBGC premium is going to be increasing to 4% or to over 4%. There's sort of this arbitrage opportunity that that's occurring right now where you can borrow at a cost less than you would be paying in PBGC premiums. So I'd say that's one thing to consider. Another I would say is to look at your investment portfolio. I mean, to the extent that you're invested highly in fixed income, you're already kind of hedged against that interest rate movement. So one potential option would be to transact on your retirees or a portion of your plan that's already invested in fixed income.
I think, too, also the opportunity cost, so the part of the plan that's not invested in the fixed income while you're waiting for rates to go up, what's happening to that, what's happening to your equities, what's happening to other things. So it's really a much more holistic, as Alex, as you were saying, a much more holistic decision than just what interest rates are doing.
Great. All right, we got another one coming in. What is the market's current position on pricing deferred liabilities?
So I'll take this one again, and then I'll turn it. I guess I'm hogging all the questions, and then I'll turn it over to Jeff maybe to elaborate. But Peggy talked about this a little bit earlier about how the deferred population is much riskier to an insurance company versus a retiree population. So I think really each insurer has their own view on the deferreds. I know last year we did see some hesitancy in the market of insurers wanting to transact on a deferred population. I don't think we have seen as much of that this year. And I do know that even in some of the transactions that we've participated in, that there have been a couple of insurers that were only interested in the deferred population. So that's my 2 cents. Jeff, do you have you seen anything different?
You covered a lot of the points. I think the one interesting one is that there are a couple companies out there that are interested in deferred liability, where the trend with most of the insurance companies is to look at the retiree liability. Typically, where you'll see the deferred liability is in a plan termination, and you're not seeing plan sponsors settle term vested liability through annuity purchases. So with a plan termination, there are more than one ways to go about a plan termination that can benefit plan sponsor and preparing the market for what is to come. And the reason you have to do that is because there's competing priorities out there for insurance companies from a liability standpoint. Each insurance company has different underwriting requirements, whether they can underwrite specific death benefits, cost of living adjustments, lump sum, optional forms, structuring your lump sum. Not to go on too much of a tangent, when you are offering that lump sum is very important from a standpoint of down the road when you're going to have to move that liability. And insurance companies are generally managing liabilities for the long term. So if you have an unlimited lump sum feature, which is basically the ability of a participant to call on that cash at any point, you're going to scare a lot of insurance companies away because that's not what they do. So it really depends on how you go about it and the timing around it, that will dictate which insurance companies will be available to take that liability. So preparation, as we talked about before.
All right. In regards to the retiree population, we have a question. Why do a retiree-only PRT deal, and what is the good path out?
I'm sorry, I missed the second half of the question. Why do a retiree-only deal and
what is a good path out?
Jeff, do you want to take this one?
Yeah. I actually have. There's a couple different ways. I'm going to use just kind of an example of what we've seen. We had a plan sponsor that in 2007, because funded status was back up from, the collapse in 2001, 2002, decided to offload a portion of their retirees. And every 4 years since then, so 2 additional transfers, they have settled the retiree liability to the point where 9 years later, they are now in position to terminate their plan, whereas looking back, again, visionary history here, but they wouldn't be in that position right now. So they had determined that their path out was to settle portions of the liability, in this case retiree liability, along the way, dollar cost average, whatever you want to call it, so that they could get to termination. And here they are, where they wouldn't be if they hadn't done that. Another scenario that we've seen is full settlement of retiree liabilities and annuitization of those participants going forward. And on the other side of it, lump sum offerings to term vesteds and the cash out opportunity at retirement. So basically, as you're clear out your books from a retirement standpoint, get out of the benefits paying business, longevity risk. As I think it was Peggy, it might have been Alex mentioned, you can redirect your portfolio maybe more to growth on that longer term duration, and as that liability comes to payout status, i.e. retirement, remove it immediately, whether you're paying out the lump sum or you're annuitizing that participant or participants as that retirement activity happens. So those are 2 examples of a path out using risk transfer that may not be, traditionally thought of.
And I think the more traditional one that we see plan sponsors thinking about now is maybe I can't afford to do all my retirees now, I'm going to do the ones with the small benefits. So just another flavor of the same idea, some now, some later, dollar cost average your way out of the liability.
Well, as an example of that, made me think of an example of that, a larger client that was able to, for $6 million, that was the cost to transfer 1,000 retirees. They were at the PBGC premium cap, so it effectively saved them roughly a little over $500,000 a year in PBGC premium expenses, not to mention the cost of administering 1,000 participants for $6 million, which was a fraction of the total plan liability.
Right.
All right. Well, we're getting close to our end time, but I do have a few more really good questions coming in. So we're going to push on a little bit further, answer a few more questions, probably go closer to the 2 o'clock hour. But there's some really good ones coming in, so I'm just going to go ahead and proceed. So we've got one here. How quickly can a pension risk transfer be executed?
Peggy, do you want to take that one, or Jeff? Jeff, why don't you go for it?
Okay. For plans starting day one, I would say, you're looking at anywhere from 1 to 3 months, depending on what liability you're transferring. A couple considerations there are, your data, getting your data together, getting it out to the insurance company marketplace, getting them comfortable with it, and the actual time that it's going to take to set up the benefit payments with the insurance company, which, again, depending on the group, the size of the group, it can take anywhere from 45 days to a couple months. And again, the most important thing here is that nothing is interrupted to the participants. So I go back to the point that I made earlier. It's something that once you get through that legwork of cleaning your data, understanding the process, understanding the cost, the carriers available and how they operate, it makes you much more flexible and a transition much more quicker. You get that legwork behind you. So I would say, it can be done as quickly as a month. It can be, a couple months to actually get that liability transferred. There's a post-transition side of it where it's more formality of notifying the participants and getting the certificates issued in the contract, and that takes more time. But by that point, the liability is off the books and it's with the insurance company.
All right. I've got a good question here in regards to kind of the future of this industry, and the question goes, Why don't all DB plans de-risk? Can a DB plan use an in-plan lifetime income product instead of an external annuity? And if finance is needed, where does financing usually come from? Those are a few questions, but if someone wants to pitch that and answer, go for it.
So the second part of that was, if financing is needed, where does it usually come from?
Yes.
I think that plan sponsor would typically go to their bank or wherever they go when they typically borrow money. As Alex mentioned, the low interest rate environment makes this a great time to do that, especially if you have a good credit rating and the ability to borrow at a good rate. So I think that's typically where the funds come from. And then the first part of the question was about, I remember it and I just don't remember it. What was it? What was the first part of it?
Sure. Why don't all DB plans de-risk? And then the second part of that is, can a DB plan use an in-plan lifetime income product?
Oh gosh, I don't know why all plans don't de-risk. I think you have a variety of situations. So you have plan sponsors that are underfunded, that are shooting for the moon with investment strategies, and really hoping that they can close their funded status gap as much as possible by making more aggressive asset allocation investment choices. You see this among some public sector plans where they're fairly underfunded. You also see plan sponsors who de-risk themselves. So they've closed or frozen their plan. Maybe they have very sophisticated in-house investment expertise, and so they feel comfortable managing the amount of risk that they have. Maybe the pension plan is very small in comparison to the size of the overall company, so it doesn't really move the needle on risk. So those are, some basic reasons why a plan sponsor may not transfer risk, or may decide that they're going to manage the risk in-house.
Okay. And then the other piece of that question, can a DB plan use an in-plan lifetime income product instead of an external annuity?
I think the answer is no. That's not been done. And I don't know what the cost benefit of that would be. It is a defined benefit plan, so it is an annuity. Somebody could, upon plan termination, I suppose, roll over their lump sum to a 401k plan and get a lifetime, payout on it, option on it that way. I suppose, if that's what they do. I've never seen or heard of this for a DB plan. I normally see that as an option in a 401k plan.
Yeah, what that made me think of is maybe like a longevity risk transfer, which is something that is happening across the pond, but it's a newer concept here. Or the buy-in. I think the buy-in is somewhat of an in-plan de-risking option where you've effectively transferred the risk associated with the liability, matched your asset to your liability, but you're still administering that benefit, and there really is no settlement accounting result of the transfer. So that essentially, outside of what was just mentioned with the DC plan income option, that was the first thing that came to mind.
But everybody has an annuity option in the DB plan. Perhaps one negative of that is if you elect a life annuity and you die the next day, there's no residual value in an annuity in the pension plan, whereas with a lifetime income product there you normally would be. But that's not a DB concept. A DB concept is lifetime income. And then more recently we've seen more and more lump sums being offered.
To the point of the... Go ahead, Krista, sorry.
No. Go. Do you want to finish your thought, Jeff?
I was just going to say I read a report yesterday that was sponsored by Prudential, a clear path analysis, that 50 to 75% of plan sponsors are de-risking. I think I go back to the point of just more awareness about risk, about options. So it is an increasing trend, and it has been going on in different capacities, whether it's freezing, curtailing benefits, et cetera, et cetera. It's just not thought of maybe as de-risking, as Peggy mentioned.
Sure. All right. Here's another question. For a frozen plan, does it ever make sense to do a partial buyout?
Absolutely.
Yes.
Yeah.
I think that they're the number one candidate.
Yeah, I mean, I think what the question is would I ever do a partial buyout? Because typically a frozen plan, the long run objective is to terminate the plan eventually. And so if you're not in a position now that you could terminate the whole plan, you might want to consider lump sum window for vested terms, annuitization of the retiree population, and then, managing a much smaller plan until the time when you can terminate that much smaller plan. So I think there's certainly a role for segmentation. I don't want to imply segmentation only applies to a frozen plan, though. It can apply to an ongoing plan, too, for perhaps a sponsor who just feels their plan's too big and they want to do, for example, a retiree transaction.
All right, we've got one more in here. I think we'll do one more, and then we'll close out for the day and answer any questions offline. Another question is, do you foresee the increase in the deferred vested annuity purchases due to the increase in PBGC premiums?
Yes. Go ahead, Jeff.
I was just going to say, I think we're seeing that with the lump sum offerings. From an annuity side, possibly. I think it depends on, maybe the size of the benefits. I could see a plan going in there and carving out small benefits and the options available to that participant. Lump sum windows are a much more efficient way of taking care of that liability now, but I could see that happening.
Jeff, I don't know whether you agree with me. I think that that this really kind of drives plan terminations for a plan sponsor who now just says, I've really kind of had it. And so I would think that it is contributing to plan sponsors who maybe have the money, who otherwise would not have put the money in the plan to terminate it, to say, I'm just going to get rid of it.
Yeah, and we didn't touch on this, but really the only way to transfer the risk associated with your active population is to terminate the plan.
Right.
So if you have a large active population in a frozen plan, really the only way to risk transfer is through plan termination. So that's a good point.
Great. All right. Well, I think that is all the time that we'll have for today. As a reminder, any questions that we did not get to will be answered offline. I'd like to thank Alex, Peggy, and Jeff for a great panel. A replay of today's session will be sent to all attendees via a follow-up email. And please keep an eye out for future webinar invitations. And on behalf of the panelists, organizers, thanks for tuning in and have a great afternoon.